Well, ladies and gentlemen, I am Sarah Lowther, and a very warm welcome to today's Master Investor webinar, which is showcasing the best in oil and industrial gases and energy-related opportunities. Now, over the next hour and 15 minutes, you'll get an overview of the established, the emerging, the hybrid, and as I've said already, the opportunities. Now, this is an interactive webinar, so if you have any questions you'd like to ask the presenters, please put them in the chat or the Q&A feature, which you'll see on your screens there, and we'll endeavour to get through as many as possible. Each presenter has 20 minutes in total, so we're going for about 15 minutes presentation and 5 minutes Q&A. Okay, to our first speaker now, who is setting the scene for the sector. It's Callum Macpherson, who is Head of Commodities at investment bank Investec. A very warm welcome to you, Callum.
Hello, Sarah. Thanks very much for having me on the show. And hello, everybody. Well, I should just start with a very quick disclaimer, just to say that I'm not a researcher, and nothing that I say should be construed as investment advice. But with that out of the way, let's get stuck into energy markets. So if I go to the first slide, please. Thanks very much. Actually, that's not the first. Is there another slide before that? That one. Perfect. Thank you. Thanks very much. Well, I think it's a good idea just to start high level with a look at the behavior of energy prices overall. So we have a chart here of oil and gas prices in Europe and Asia, and also US gas prices all in barrel of oil equivalent terms, so that they can be easily compared with one another. And what we've seen, particularly over the last 6 months, has been a normalization in the relationships between these different sources of energy. Typically in the past, gas has traded at a significant discount to oil prices, and US gas in particular has been very cheap due to its sort of relatively landlocked nature, albeit that changing to some extent with the advent of LNG. But these normal relationships were thrown completely out of kilter in 2022 because of the Ukraine war, and gas traded at a very substantial premium to oil. But now, as we see, that has moved much more back into the normal sort of relationships between these sources of energy. Well, let's focus now on the oil market. So if we could have the next slide, please. So for much of this year, Brent has been strengthening. This was fueled perhaps by two things, maybe three things in particular. One was the worries over supply and transport of crude oil connected with the ongoing war in Gaza, and disruption to shipping through the Suez Canal and the Red Sea and all that sort of thing, and indeed the possibility of an escalation between Israel and Iran. Then we've had, on top of that, OPEC Plus taking steps to try and manage the market with additional voluntary contribution cuts, which were rolled over during this period. And also, I think the economic climate has not turned out to be quite as bad as had been expected. So demand has been perhaps a bit stronger than people had feared. But this somewhat went into reverse in the last month or two. Oil reached a peak over $90 per barrel when there was the sort of peak concern about possible escalation between Iran and Israel. But as those concerns have faded, so the market prices have come back down again, and indeed have recently started to inhabit this sort of $80 to $85 per barrel range that was typical during March and February this year as well. Now, there was a wobble a couple of weeks ago when OPEC Plus unveiled their plan to unwind the additional voluntary contributions and bring more supply into the market, particularly into 2025. But that was then, that sell-off reversed quite quickly after the Saudis were very pointed in saying that there was a caveat that they might not go as quickly, or they might halt it, and so on. So essentially, sort of kicking the can down the road a little bit on when they would bring supply back into the market. Next slide, please. and you can see this this sort of the investment behavior coming through in these charts showing long the positions of managed money, speculative money in the market. You can see the green line, particularly on Brent over there. That's the net long position came down very sharply. So it had increased as investors were putting more money in, and have then become much more bearish again. If we turn to the next slide, we can see start to see or consider how this is looking from a consumer side. Again, rather like the gas market, the spreads between crude oil and refined products went completely haywire in 2022. We saw jet and diesel trading at premiums that we've never seen before over crude. But these relationships have started to normalize or have normalized. And particularly in the last few months, we've seen weakness in the refined product markets. And so the premium of jet and diesel over Brent crude has been coming down. There's been particularly strong supply from Asia in recent months, and this has tended to lead to the market getting a bit oversupplied in refined products, and of course ultimately that has to feed through into crude oil prices as well. Otherwise, the refineries will be losing money on continuing to produce products. We are at the start of the summer, of course. This is a peak demand season for the oil market. Increased jet, diesel, gasoline, and so on, and we would expect this to support prices to bring down some of the inventory and some of the excess supply. So the market is quite likely to be relatively strong over that period. But as we get into the autumn, once that's out of the way, then I think the questions are likely to come back around OPEC Plus and how it manages the market, and whether it's able to roll over these or able to go ahead with its plan to unwind the additional voluntary contributions, or whether instead it will have to continue rolling those over, albeit as painful as that will be for some members like Saudi Arabia. Let's now move on to the gas market. So if we could have the next slide, please. So European, this is a chart showing the trends in European gas inventories. The red line is the current year, and this is superimposed on previous years. So you can see that the gas in storage is around the highest level it's been at this time of year, looking back historically. So the market is in a good position from that perspective, and of course we've had 2 successive mild winters, and this has certainly helped this. But the question is, does this strong inventory position indicate that the energy crisis is over? Does the fact that prices in the gas market across Europe have returned to something like pre-war levels, and the curves now relatively flat, does this indicate that the problem has gone away? Well, if we go on to the next slide, please, we can see a recent history of gas inflows into Europe. So down at the bottom of the left-hand corner, you can see the various Russian supply coming through different pipelines. Obviously largely disappearing, although not quite. There is still some gas coming in from Russia through pipelines, ironically through Ukraine. Then we have, on top of that, we have the LNG imports, and on top of that we have Norwegian supply as well. And if you look at the top of this graph, which shows you total supply, so neglecting just the breakdown, you can see that overall the supply of gas coming into Europe, okay, it goes up and down quite a bit, but it is still quite a bit lower over the last couple of years than it was before the war started. So the simple answer to the question, has all of Russian supply been replaced? The answer is no, it hasn't. And that begs the question as to whether the market is being complacent, and what the risks might be in the gas market going forwards. Because the fact is, we've had 2 mild winters in a row. We've also had a reduction, so that's reduced heating demand, and we've also had a reduction in industrial demand as well. And these are things that could change. In particular, we might have an unusually cold winter this year, the situation could then look very, very different. We might see quite rapid drawdowns in gas inventories. It's also worth, when we're on the topic of volatility in gas markets, it's also worth thinking a bit about the changing role of gas in the power generation mix. And if we go on to the next slide, what this shows is the monthly average as a percentage of gas being used in the energy grid in the UK versus other sources of electricity generation, of course, including renewables. And clearly this moves around a lot, but it is noticeable there is a general trend towards gas making up a smaller proportion of the energy mix. And this is because it is increasingly being pushed out of providing baseload generation, which is sort of continuous supply 24 hours, 7 days a week, and is much more providing a sort of backup to renewables and coming on when renewable generation is low and switching off again when renewable generation is high. So there we are. So lots to think about in the oil and gas markets, and also their wider role in energy markets more generally.
Many thanks, Callum. You certainly tickled me when you said that the gas markets are possibly being a little bit complacent. But you talk about Russia and geopolitics quite a lot there. Which events really have the potential to change the dynamics in the oil and gas sectors? Would it be peace between Ukraine and Russia, or the world being bullied by a Russia-North Korea alliance?
Oh gosh, that's it's quite a question. Well, I don't. I mean, well, I suppose if there was peace with Ukraine today, and if Putin resigned, and that there was, and the Russians agreed to maybe pay reparations to Ukraine to rebuild the country, if all of those things happened, then maybe that would be the condition that the sanctions could be ended and supplies could be restored as before. But it doesn't seem very likely or very close at hand, I would say. So and North Korea, I don't know how much that really changes the story, to be honest. Now, there's already an alliance.
Understood. Now, as an investment bank, are you now paying more attention to the industrial gases, which have certainly caught government and retail investor imagination?
Do you mean the use of natural gas in industry, or do you mean
just as an investment bank, are you now apportioning more of your research time to looking at industrial gases, particularly as retail investors are very interested in helium-related stocks, for example?
Well, I'm not, as I mentioned at the outset, I'm not a researcher, so I'm not really involved in that side of thing. But I mean that side of things. But I mean, I don't see the role of gases broadly in the market having changed particularly. And obviously, helium is a completely different kettle of fish to natural gas in terms of its usage,
as we're going to find out within this webinar. So finally, what does the internet, I want you to summarize this for me, because I must admit I'm a bit of a nerd when it comes to the International Energy Agency. What does the International Energy Agency's latest report reveal about the state of the oil market now?
Well, it released two reports a couple of weeks ago, or was it last week, which were, I think, you may have been referring to either one of those, but they're both about the oil. So essentially, one is a short-term report and one is a long-term report. And the short-term report wasn't really dramatically different to any of their recent ones. That the message remains the same. That demand is growing and will grow again in next year, but that non-OPEC supply is their forecast is going to grow faster than demand. So consequently, so if you see, because they don't actually do a forecast for OPEC itself, but they say, well, in order to balance the market, OPEC is going to need to produce this. And what their report says is that in 2025, OPEC will need to produce about 26.5 million barrels per day. Whereas it's currently producing about 27 million barrels per day, and that is with the additional voluntary cuts in place. So what the report implies is that even if OPEC carries on as it is, the market will be oversupplied next year. But if they go through their plan to unwind those additional voluntary cuts, then the market could be very oversupplied next year. So that's the way I would see that in a nutshell. But that's not changed particularly in their latest report. They've been saying that sort of thing for a while. I think what's much more interesting actually is their sort of medium-term outlook, which goes out to 2030, where they are saying that they see peak oil by the end of this decade at 106 million barrels per day. And that compares with current supply demand of around 103 million barrels per day. So really not very much supply growth, room for supply growth there going forward. And of course, the explanation for this forecast lies in electrification. So that the largest source of oil demand is road transport, making up for the best part of half of all oil production. And that is the part of oil demand that is most straightforward to decarbonize by electrifying it. And that process is underway, particularly strongly in China, of course.
Very good. Well, thank you. I'm going to have to stop you there. I realise that question, I've unleashed a beast, but we
It
took
could go on for hours, yes, but
Callum, thank you very much indeed. Callum Macpherson, Head of Commodities at the investment bank Investec. Thank you very much. And it's the first time I've heard the gas market being referred to as complacent. Thank you. Certainly something to mull over. Thank you very much indeed.